I stand by my statement. The additional capital we raised wasn't to meet capital requirements or deposit requirements. The decision to restrict GameStop and other securities was driven purely by deposit and collateral requirements imposed by our clearinghouses.
No, there was no liquidity problem. And to be clear, this was done preemptively.
But explain then, why did you do this? What, did the SEC call you and tell you you had to do this? Was there a problem inside the company in terms of liquidity, in terms of the amount of deposits that you had to put it in front to the exchanges?
A margin call happens when the margin available to cover any losses falls below a certain level. At that point, the banks demand the investor puts up more margin in form of cash or other collateral. If they fail to do so, the banks may have to sell their holdings to reduce their own risk. Day traders and spread bettors often get margin calls, but it also happens to institutional investors, such as hedge funds. The risk with such margin calls is that if one heavily leveraged seller is forced to sell their shares, this might trigger margin calls for other investors, resulting in a domino effect.
Let's put it this way. If somebody's getting margin called on them, that's not good. That is not what you want.
And so Thursday morning, right? So I'm sleeping, but at 3:30 a.m. Pacific, our operations team receives a file from the NSCC, which is the National Securities Clearing Corporation. So basically, as a broker, as a clearing broker, and this is where Robinhood Securities comes in, we have to put up money to the NSCC. Robinhood, as a brokerage, has lots of financial requirements, SEC requirements. We have to put up money at clearinghouses. The amount of money that we have to put up depends on market volatility, and we're in a historic situation where there's a lot of activity and a lot of buying concentrated in a relatively small number of symbols that are going viral on social media.
It's like, hold the line, hold the line, hold the line, don't sell, have diamond hands. Diamond hands, baby.
A lot of the Wall Street firms are highly leveraged. That is, they are running with a lot of debt, an enormous amount of debt. And what they're doing is they're projecting using mathematical models the ranges of probability that they can invest within with that debt that will allow them to be profitable. And if those kind of ranges of volatility are exceeded, then what happens is the company rapidly gets into a situation where it can go broke.
In order to protect the firm, we had to limit buying in these stocks. So we haven't really seen anything like this before. And to prudently manage, we had to restrict buying in these 13 stocks.
So as the rules are today, the long broker has to, if he can't get the shares, he has to go into the market and buy the shares at whatever the price is. So that could have pushed the price further up into the thousands. When that happens, obviously the shorts cannot pay up. So the brokers, they default on the brokers default on the clearinghouse.
The reason we did it was because Robinhood is a brokerage firm.
I was scared of a domino bankruptcy. I mean, I tell you, the rules require the long brokers to go into the market and buy the shares at whatever price. So that drove the shares up to $480, and then suddenly, I guess, it didn't go further, but it could have gone further.
In order to protect the firm, we had to limit buying in these stocks.
But it sounds to me, though, that you're suggesting that there was a liquidity problem inside the firm. And my question about that then raises all sorts of new questions about whether there's a systemic issue underneath the system and underneath the company unto itself.
And why did folks get locked out on the buy side only?
But then why did you allow people to keep selling but not buying? The reason that is so troubling to people is that they were making money buying the stock because they were against the short side.
Preventing customers from selling is a very difficult and painful experience where customers are unable to access their money. So we don't want to impose that type of experience on our customers unless we have no other choice. And even though I recognize customers were very upset and disappointed that we had to do this, I imagine it would have been significantly worse if we prevented customers from selling.
Starting around October 29th, CoinMarketCap.com said they were starting to receive reports from crypto traders saying that they were unable to sell their coins on the decentralized trading platform PancakeSwap. They urged traders to proceed with caution when buying the coin. Of course, most of the buyers ignored these warnings and started pouring more and more money into the coin. The developers said the restrictions on selling the coin was an anti-dumping mechanism to prevent whales from tanking the price by dumping their coins all at once. Thus, they were able to spin this highly suspicious development as a legitimate protocol that they put in place to protect the average holders of the coins. You can think of Squidcoin's decision to ban selling of the coin as having the inverse effect as Robinhood's infamous decision to ban buying of GameStop during the January short squeeze. With most existing holders unable to sell their coins, and new buyers coming into the market to get in on the hype, the price skyrocketed up to $2,800. But it just goes to show how insane it was that they could artificially pump up the price so high by preventing people from selling.
In order to protect the firm, we had to limit buying in these stocks.